Good afternoon, everyone, and thank you for joining us today. My name is Jen Martin, and I'm a Vice President on the Financial Advisory team at MarshBerry. My role is to help owners of insurance agencies and brokerages determine the best set of solutions to help achieve their strategic initiatives. This could be through the implementation of organic growth strategies, identifying opportunities to grow through acquisition, perpetuation strategies, or exploring capital options. Today, I'm here to host our focal point on perpetuation planning. Before we get started, just one housekeeping item. Everyone's lines are muted. However, our goal is to keep this session interactive. As information is presented, please feel free to add your questions to the chat. I will be monitoring the chat with my colleagues, and we will address questions during the Q&A period at the end of our session. Our firm takes great pride in the fact that most of our clients work with us to grow and improve their firm so they can choose the path that is right for them. Our topic today is intended to update you on various perpetuation options. My colleague and host for today's webinar is Kyle Hoft. As a president on MarshBerry's financial advisory team, Kyle's primary responsibilities include deal execution on both buy-side and sell-side transactions, due diligence, deal negotiation, acquisition analysis, and integration planning. He also contributes to MarshBerry's financial management consulting division, and his responsibilities include internal perpetuation planning, insurance firm valuations, business planning, compensation structuring, and organizational development. Before I pass it over to Kyle, I'll share a quick overview of our firm. We are headquartered in Cleveland, Ohio. MarshBerry has 6 U.S. locations and an international office in Amsterdam. Our expertise and focus is solely on the insurance and wealth industries, and our number one goal is to help firms create value in their business. We do this through our 3-step mantra of learn, improve, and realize. The first step is to work with insurance agency and brokerage owners to help them learn where they have strengths, how they stack up against others, and what they can do to take their business to the next level. We then leverage data and analytics to build strategies for improvement. Finally, the last stage is about realizing value. It's the culmination of everything we have helped our clients achieve through both learning about their business and improving it over time. This is where our financial advisory practice steps in to help with both internal perpetuation and external strategic partnerships. Our holistic approach allows us to put you in a position so that you can choose your own path and do what's best for your business. MarshBerry has been the number one sell-side advisor for the past 14 years. We've advised on over 1,000 M&A transactions in the insurance distribution sector since 1999, amounting to almost over $20 billion of value. With that, I'll hand it over to Kyle to provide an overview of today's session and dive into our topic at hand.
Perfect. Thank you, Jen. It's a pleasure to welcome everyone to today's focal point webinar on perpetuation planning, kind of unveiling the available routes. This is one of the biggest weaknesses, candidly, in our industry, that being perpetuation preparedness. And the goal of this focal point is that at the very least, to make you all aware of the options with a secondary goal of committing to action. Right. In order to do that, the content we'll be looking to cover today will include a few different things. A very brief overview on what makes the insurance industry one of the most attractive industries to invest in. We'll spend a significant amount of time talking through this, several different perpetuation paths with a focus on internal, external, and employee-related perpetuation. But we'll also cover some of the paths less traveled. And then we'll wrap up talking about possible next steps. Before we get into the insurance landscape, I do want to share what I feel is our responsibility as an organization to you as a current client or prospect, and that's to aggressively and intentionally confront our clients to make them uncomfortable, candidly, so they embrace meaningful and often painful change in order to remain in control of their future. Now, that may sound a bit forward, but this mantra helps align with our discussion today on perpetuation. And really, it's the last part of that sentence in terms of remaining in control of your future that we're really focused on in terms of whatever that may look like for your organization. It avoids the inevitable for most of you, which is being backed into a corner and forced to make a decision due to really poor planning and execution, specifically related to perpetuation. Let's spend a brief minute getting into the insurance landscape. So is the insurance industry an attractive industry to be in? I assume everyone on this webinar probably believes so, given it's likely been your career path for some time now. But perhaps more importantly, the world is demonstrating through their actions, not necessarily their words, that it's their belief that it could possibly be the greatest industry in the history of mankind. So let's think about that. If we did this Family Feud style and surveyed 100 people, I'm not certain that more than one individual would select insurance as the answer to the world's greatest industry. But the question is, what makes it so great? There's 10 things really, if I had to boil it down. The recurring revenue nature of our industry is something that is second to none to most other industries. On average, call it 90% of revenue typically comes back or recurs in any given year for most of our clients. And of course, that varies by line of business, but even those that are not as efficient as retaining revenue and might be below average or subpar, I would guess 80 to 85% still comes back from a retention standpoint, which is still much greater than most other industries in terms of the recurring nature of the revenue. It's a high cash flow business with low capital expenditure requirements. You've got highly controllable EBITDA margins, which makes it very attractive. It's a fragmented market, which makes the M&A growth and supplement to your organic growth strategy very attractive and certainly amenable. There's low barriers to entry related to the industry in terms of getting into insurance. There's a robust secondary market in the reinsurance market and in other places. And it's a requirement really to purchase insurance for a lot of your clients. So if they're going to buy it they have to buy it from someone, I should say. So they might as well buy it from you. There's other impacts from a tax planning and profitability standpoint around amortization of intangibles, taxable income, and it's proven year in and year out to be very stable in a down economy, dating back to 2007 through 2009 and the financial crisis, through what we just most recently experienced and might still be experiencing with the pandemic and some of the economic and debt market changes. It continues to show its resilience as an industry. So the question now becomes, if it's so great, why are so many agencies selling when at the same time everybody else is seemingly trying to get into the industry? And we'll get into that shortly. I do want to shift gears to discussing the potential paths, right, that you may find your organization evaluating, and perhaps some paths that you haven't thought of or evaluated. You'll see we boiled it down to 6 main paths up on the screen, each of which certainly offer pros and cons, some of which can be traversed simultaneously. And contrary to popular belief, we as in MarshBerry don't have a bias on which path is taken. And sure, there's certainly a place for sell sides and investment banking options. But candidly, if all of our clients sold, Jen and I wouldn't have a job much longer. And given that we're planning to be around for another 25 years or so, relationship building is paramount in our mind and really our priority focus. So we're focused on helping clients learn about each path so they can make an informed decision and ensure they're on the right path to reach their goals and objectives, whatever those may be. So back to my opening comments, by preparing and understanding the paths, the key is that you get to choose your destiny, not the other way around. And that's the whole goal. So we'll get into each of these paths to varying degrees, but in order to add some credibility to this discussion, we want to highlight the breadth of clients that we've helped in each of these areas. So you'll see some notable, what I'll call transactions. Not all of them are truly transactions, but some notable, projects that we've worked on with our clients in terms of helping them through these various paths. You'll also notice that the MarshBerry emblem is highlighted in the bottom left-hand corner of several of these paths. So starting and explaining a little bit about our MarshBerry story for those who might not be familiar with it. For a long part of our history from 1981 to call it 2016, we were your traditional organization with shareholders, board of directors, so on and so forth. in 2014, 2015, we started to realize our goal was to remain independent, but we started to realize that a typical or prototypical, perpetuation, internal perpetuation strategy might not yield the results we were looking for. And from a cash flow standpoint and some other mechanisms, we might need to make a pivot. So in 2016, we explored some debt capital raising to help us facilitate and transition into 100% S Corp ESOP owned organization. So in 2016, we no longer had your prototypical shareholders. We transitioned to 100% ESOP owned organization, and that allowed us to remain independent and in control of our destiny. Fast forward to where we are today. In late 2021, early 2022, we then considered and evaluated taking on a minority equity partner and ultimately chose Atlas Merchant Capital. In late 21, early 2022, we disbanded the ESOP for lack of a better term and took on a minority investor. And now the majority of the organization is owned by traditional shareholders again. But that was a decision we made in order to make the investments that we needed to make to continue to grow and again, remain in control of our destiny. So if we're going to talk the talk, we also want to have pride in the fact that we've walked several of these paths alongside our clients as well, most notably internal perpetuation, ESOP, equity partner, debt capital raising. So we feel strongly about these as potential options and feel strongly that they can be worked, simultaneously or concurrently in some instances. So let's get into our first component, and that's internal perpetuation. So there's a path of internal perpetuation, which allows firms to obviously remain independent and be the captain of their ship, so to speak. Having an internal succession plan can be utilized as a recruiting and retention tool. It can facilitate a positive culture. It can be a wealth creation opportunity for the next generation, and even motivate employees to perform at a higher level, knowing there's a plan in place. And frankly, one that they might be actively participating in. The dictionary definition, according to, I believe, Webster or your local dictionary, on succession is the right act or process by which one person succeeds the office, rank, or estate or link of another. The key words in that definition being act or process, which means execution of a plan had to be involved, versus the unfortunate general insurance agency definition that we see much more often, which is more along the lines of declaring to the world, your employees, your friends, all the buyers that call you on a weekly basis to purchase your business, that you are 100% committed for remaining independent. Despite full well knowing in the back of your mind, you have no real plan in place to actually execute on that declaration. It's a very common circumstance we see with a lot of clients. So for all of you fans that might be or might be fans of The Office, a more satirical example is similar to Michael Scott declaring bankruptcy to his staff, to which Oscar casually reminds him that he cannot simply verbalize it and expect something to happen. It requires a plan, action items within the plan, and most importantly, execution of the plan, to which Michael responds, "I didn't say it, I declared it." So what are some of the questions to ask yourself when you're truly evaluating an internal perpetuation path? This is an all-encompassing list, but certainly some questions for consideration, largely centered around a commitment to the process, right? And a willingness to bring future leaders into the conversation. Who is the next generation of leadership going to be? Do you have them now? Do you need to recruit them? Do they know what it takes to be a shareholder? Are you willing to take a discount compared to what you could get externally? Does the next generation have access to capital to buy it in? Are you going to hold a seller note? Are they going to go external financing? How long of a runway do you and your partners have to make all this happen? We'll talk ad nauseum that perpetuation is not an event in time or something you do once. It truly is a lifestyle, which means you need time to effectuate that lifestyle. Do you have shareholder agreements, buy-sells, shareholder criteria that contains objective and subjective components? Again, these are just some of the questions to have answers to, and I venture a guess that many of you have some of these questions answered in some way, shape, or form if this is your ultimate path. but many of you likely have more of an informal plan in your head. Interestingly enough, according to our Market and Financial Outlook survey that was done in 2019, 2020, nearly 80% of respondents believed that the next generation were actually capable of taking over the agency. However, those same respondents, only 23% of them actually offered or made available stock within their organization for that next generation they said was capable of taking over. So actions did not translate into the words that they were saying, right? The result was the current ownership is really tricking themselves into believing the next generation is identified and capable. But again, those actions don't support the words. Perpetuation is a process, it takes place over time. I mentioned it's a lifestyle. It's not a one-time event and you're done. You really need to think about releasing the talons from the equity within the construct of a defined plan to really make this effective, especially because the study further indicates that ownership is broadening and has been broadening too slowly in most organizations. It's really difficult to perpetuate a $10 million organization internally when you only have 3 shareholders and likely even fewer qualified candidates to take that over. It really should be a 30 plus year cycle. And to put that into kind of perspective visually, you'll see that, you get shareholders involved at an early enough age. The first 5 to 7 years, they're kind of accumulating debt and purchasing the amount of stock that they're ever going to purchase in those 5 to 7 years. They spend the next 10 years paying off that debt to former shareholders through a financing mechanism. They enter a stage of unencumbered distributions where they fully paid off the debt, and now they're just realizing the gain of the, being a shareholder and the equity distributions. And then eventually, they realize the equity of those stock sales or the receipts from those stock sales, whether through an internal sale, external sale, whatever it might be. But generally over the course of time, from an internal perpetuation standpoint, that would wind down over 10 to 15 years. So it can be a 30 plus year cycle, in some instances that you would have to kind of rinse and repeat. Some of the components of a good succession plan really come down to 4 interconnected gears. Without these 4 things, internal succession is going to be nearly impossible, frankly. You got to have the people. You got to have the next generation not only identified, but have an action plan to get it in place. They have to have the capabilities and drive and leadership to participate in the perpetuation plan. You've got to have willing, committed buyers and willing, committed sellers. After all, as well as I know, the insurance business is a relationship business. So without the right people, it doesn't make a lot of sense to even go down this path because they're that critical to, the ongoing success of an internal perpetuation plan. The next generation needs to be capable. They need to be seen as leaders. They need to be respected by their peers and colleagues. There's a lot that goes into it, and those individuals are not easy to find, as I'm sure all of you are aware. I don't know the exact stats, but one owner, to find one true owner, the number of actual employees that would come in the door are pretty significant and staggering to find just one owner that can commit to this. The plan and the financing kind of go hand in hand like an interconnected gear. There has to be a commitment to both. The valuation needs to be agreed upon. The buy-in and out terms need to be formalized and documented. And it's important to have seller terms and expectations of what it means to be a shareholder so the next generation has a clear path to perpetuation. It wouldn't make a lot of sense to have you all as owners take a discount compared to what could be achieved externally, only to have the next generation not really committed to the internal succession plan in which you got to figure out an alternative anyway. It's a complex iterative process. Financing also needs to be determined as part of that. Are you going to seek external financing or are they going to seek external financing? Are you going to hold a seller note and feel confident that they're going to be able to repay you over time? Are you going to explore debt capital raising to help fund the transactions? What is the level of risk associated with your plan and the cash flow modeling? And are you comfortable with it? The final component is there has to be a commitment to make succession part of the culture. So there's a passion and action around being independent. It should be filtered through the hiring processes, communicated to the staff on a regular basis. It again should be used as a recruiting and retention tool. It should be viewed as more than just a stock transaction. It should be pitched as a wealth creation opportunity. And while there are no guarantees, the risk reward matrix can be significant for certain individuals. So what are some of the key takeaways? So you got to handle the basic blocking and tackling first. You got to identify the next generation. You got to have a plan to get them in place. You got to illustrate what it takes and what it means to be a shareholder. Succession is very nuanced and very complicated, and you shouldn't underestimate it, both in the time and energy it takes to kind of put a plan in place and continue to execute the plan. It's a wealth creation opportunity, and it should be showcased as such, despite no guarantees on future performance or what the future might hold. You got to walk the talk and embed it in your culture. And although it can be difficult, generally where there's a will, there's a way. The next most common option is selling to a strategic buyer. So individuals committed to this path have made a decision that they'd rather own a smaller piece of a watermelon than 100% of a grape. In fact, some of our clients have made substantially more, even on the equity investment of a strategic, a partner with a strategic buyer, that they rolled throughout the transaction in comparison to the cash proceeds received at closing. That's the whole name of the game, is to realize that arbitrage. That's a success story in and of itself if that happens, right? The employees of our clients who take this path oftentimes also have greater career advancement opportunities, access to a larger suite of tools and services, and a host of other options as compared to remaining independent. But it also comes with the risks of, they don't directly report necessarily to the management team that they have and are used to and accustomed to reporting to. The insurance marketplace has historically been and continues to be very fragmented, which has certainly contributed to the overall M&A appetite in the space. You can see the projections there from 2025 through 2035 highlight a decreasing number of firms with revenue of 10 million and below, projecting continued consolidation in the industry. However, what's interesting is that bottom tagline. There's been over 6,000 deals from 2011 to 2022, but only a projected decrease of roughly 1,500 firms, showcasing a fairly good regeneration rate, candidly, of insurance agencies getting back into the space. So all other things being equal, this should continue to foster a healthy M&A environment and provide ample demand for individuals looking to explore this route for many years to come. If we look at the actual transaction activity, we continue to see record years being set, largely 2013 to 2021. The total number of announced transactions has continued to eclipse the previous year, with the exception of 2016, which slightly down compared to 2015, but not by much. And private equity continues to be a major driving factor in the M&A activity. They've gone from one transaction in 2006 to 709 in 2021. That took a little bit of a step back in 2022, but that's more a function of the total deal count. They're still dominating the space with that red bar. This also only includes announced transactions. So for what it's worth, there's hundreds of, or a varying degree amount of transactions that are also not announced that aren't in these numbers. And so the greater swath of actual transaction activity is likely a little bit greater than what you're seeing here. But the optionality available in finding the right partner has never been greater than it is today if you're considering this option. When you couple this with valuation, base purchase price continues to be at an all-time high. Over the last couple of years, valuations have been roughly 144% higher than the 10-year average from 2010 to 2019. And for those that don't execute on a formal perpetuation plan, internal ESOP or something to the like, the intoxication to go this route becomes greater and greater with every passing day, to the point where it's borderline irresistible because of the delta between internal and external valuations is simply too big of a chasm to ignore any longer. And they're swept into kind of the undertow of, what seems like the easy solution. Structural considerations are also important for those looking to pursue this route. You'll certainly want to have one eye on structure considerations and the impact. I'm sure we're a broker dealer and FINRA regulated, so I'm sure my compliance department will be happy to hear the following disclaimer that MarshBerry does not provide tax or legal advice, nor do we hold ourselves out to be qualified to do so. But from a business perspective and a corporation status, there are some considerations that you should be speaking to your advisor about to make tax planning as efficient as possible. We can tell you that based on our proprietary data, I would say roughly 85% of all transactions are typically asset purchases, which is most often the preference of buyers because of favorable tax considerations on the buyer's end. So keep that in mind, depending on if you're an S Corp, you're a C Corp, or a partnership or structured in some manner. It's important to have those conversations with your advisors. Just know that based on what you see on the screen, there's several options to affect a transaction and get it at capital gains tax treatment. Most notably, if you're an S Corp, this becomes the most efficient, I'll call it, in terms of the tax planning structure. But the tax plan or the organizational structure itself is paramount. I won't go into grave detail on all the bits and pieces of this slide. However, did want to show what a typical transaction timeline might look like, broken down into three main segments that span on average between 5 and 7 months, I would say. These segments largely fall into kind of a preparation phase, a marketing phase, and an execution phase. This is MarshBerry's proprietary process that we facilitate, that we find successful to facilitate a process from beginning to end. Whether you're considering MarshBerry or another advisor, this should be your expectation of a work product from your advisor that you choose. Anything less than this is frankly inadequate. And if you're considering going it alone because you do some small M&A, feel like you have a good grasp on everything, I would strongly urge you to reconsider and hire some type of advisor, even if it's not us or one of our competitors. It's better to have an advisor than to do this on your own in terms of all the nuances that go into this type of just perhaps the most important decision you'll make with one of the largest assets you have in your portfolio. So in summary, the M&A environment should remain strong compared to historical norms. We likely won't be as robust in terms of the number of announced deals as it was in 2021, but 2021 had kind of a perfect storm in terms of pandemic and political ramifications and capital gains implications. There was a lot going on that drove a lot of activity in that year. Reduced buyer demand and small group employee benefits will largely continue. This has largely been abated over the last 5 years, I would say, but there's certainly still a proclivity for larger, mid, and large employee benefit firms. The increasing age of the average agency owner, right, and the inability to plan appropriately to perpetuate will continue to drive consolidation. No matter how much MarshBerry or others preach about internal perpetuation and what you need to do to prepare for that, there's still going to be clients and firms that kick the can down the road and ultimately have the decision taken out of their hands. Private capital providers continue to seek new investments in the space. The demand far outweighs the supply still in terms of those looking to get into the space. And one of the most, not startling, but one of the more relevant and recent trends we've seen is that there's broader buyer diversity. And I expect that would continue to increase. The impact of the pandemic and the activity in the debt markets has really proven and shown us that a similar number of transactions will likely continue to occur in the space. However, this activity is going to be spread amongst a broader, more diversified buyer pool as more and more continue to get into the market. Third option to consider in succession planning is an ESOP and or an ICAP. ESOPs and ICAPs are similar but different, and we'll explain a little bit about both here. Like I mentioned earlier, this is a path that MarshBerry has already been down before in terms of the ESOP we established in 2016. Prior to taking on that minority equity partner with Atlas in 2021, 2022, we were 100% ESOP owned. Oftentimes, there's a higher valuation that's possible through the implementation of an ESOP versus going traditional internal perpetuation. And you still get to retain your independence. So kind of an added bonus there. And that's just one of several potential benefits in terms of ESOPs. But again, the transaction structure is important. Similar to the strategic sell side, depending on your corporation status, there are pros and cons on each side of the ledger. Perhaps the most important, S Corp pro is that 100% ESOP owned companies that are S Corps are not subject to income tax at federal and oftentimes state levels due to the tax exempt nature of the trust that has to be set up. The biggest con is there's no real tax-free rollover options with an S Corp ESOP, but it does receive capital gains treatments on the proceeds to those individuals later down the line, which can be beneficial. C Corp pros and cons get a bit more complicated, but largely revolve around the 1042 tax-free rollover options. if you're interested in learning, there's certainly more to dig into on this, much more. But if you're interested in learning more about this option specifically, I would encourage you to follow up with me or Jen after this session, and we can certainly dive into that in greater detail. Some other considerations, if you're considering kind of an ESOP perpetuation strategy, annual evaluations are pretty typical, requirement by independent third parties. It can motivate your workforce and them having a sense of ownership in the organization and higher productivity. There's certainly significant startup costs, upwards of $100,000 plus to kind of setting up the trust and getting it all set up. But it does allow you to maintain your company culture and rewards the employees down the line. And again, gives them more of a sense of purpose. There's cash flow considerations you want to consider to cover the ESOP loan repayments and the debt servicing. That's important to keep an eye on, often an overlooked, item. And contributions are typically tax deductible or tax deferred in some way. So again, want to talk to your advisors about what that looks like and how that's set up. IRS has their hands in this pretty heavily, so the rules are strict. It's certainly, you're going to want to understand that. And there's certain criteria that need to be met to maintain these tax advantages. So again, if this is something of interest, connect with us after the session and we'll dig in more detail. Another related option is to explore a proprietary, MarshBerry product called an Integrated Continuity Alignment Plan, or ICAP for short. I'm not going to be able to do this justice in a couple minutes. However, the ICAP solution combines multiple features to create a customized structure that is aimed at aligning the interests of shareholders, shareholder value, the next generation, keeping the culture intact. The ICAP really provides shareholders a means to divest their shares at near full market value and ultimately realize a greater value if you incorporate seller notes, synthetic equity, and even ESOPs. ESOPs can actually be a part of an ICAP plan, which is a unique nuance to the ICAP. And again, the goals, it's structured uniquely to the goals and objectives of the organization. There's a vast amount of tools that are considered, including a lot of what I would call more sophisticated solutions we're not typically used to talking about on a daily basis, such as setting up qualified trusts, synthetic equity, warrants, options, pre-sale stock redemptions. And the financing is also customized based on the needs of the firm, using senior debt, subordinated debt, seller notes, staged liquidity, mezzanine financing, buy downs, interest rate swaps, right? The list goes on. For those of you who took derivatives classes in college, I perhaps just brought you back to some fairly unpleasant memories of learning about all those subject matters. But fear not, we have experts on staff to help you kind of walk through the complexity of all this and just what an ICAP truly could mean. So again, connect with us after the session and we can certainly explore this in greater detail. The next three options are a bit less traditional, but can still be taken into consideration depending on your circumstances. So the first is taking on a minority equity partner, which is really where MarshBerry is today, which can give you kind of that shot in your arm to accelerate growth. You retain a high degree of control and feel more independent than selling externally, and you still gain access to capital to facilitate growth. In addition to the capital, you get access to expertise that comes with the private equity partner or equity partner in general, that has a little bit more sophistication to it. The typical thesis for an equity partner is centered around two pillars. There's line of business appetite and there's targeted financial return. So many equity partners are focused on specific niche segments of insurance or perhaps more generally property and casualty versus employee benefits. And they're really looking to return a 3 times multiple on invested capital in roughly 5 years on average, we'll call it, at which time they might look to sell their interest to another equity partner. This generally comes in the form of either a true private equity partner or a private capital partner. And you might be asking yourself, what's the difference? Is there a difference? The pros of partnering with private equity can be vast, but it may not be the complete fit you're looking for versus that of a private capital partner, which might be more of what we would call a patient capital with a longer hold horizon. Private equity likely has higher upside in terms of return, more support on the backroom functions. They can provide acquisition assistance and things of the like, but it perhaps provides also more scrutiny and pressure to perform in the short term to reach that 3 times multiple on invested capital target that is commonly set in the industry. Private capital may offer lower returns, but sometimes it comes with a bit more autonomy on the day-to-day operations, a longer hold horizon, providing a little bit more continuity with your partner. A good example of private capital would be Ontario's teacher pension plan. They have investments in the insurance distribution space that, some have been held for 15 plus years, which is atypical to private equity, which is more on the 4 to 6 year kind of time frame. The cons need to be considered as well. Private equity often has minimum return requirements, which I mentioned, a 3 times MOIC. They typically have a shorter hold period, which I mentioned, 4 to 6 years versus private capital. And typically a bit more influence and control over decision making and board directions and decisions, with the ability to kind of force a sale at the appropriate time, which sounds intense, but candidly would likely be beneficial for everyone involved, and that's the whole point, is kind of flipping the equity to realize some gains. Private capital, a little bit less involved on transaction assistance and financing of transactions if M&A is going to be a big part of your growth strategy. Can offer lower returns on average just for the risk reward appetite. And they might have a more limited war chest, in terms of in a more conservative view on some of the things from a strategic standpoint. So again, things to consider when you're looking at potentially taking on a minority or majority private equity or private capital partner. Another less talked about option, and this is the option that really is a foundation to many of the other options, I would say. This is one that doesn't necessarily have to stand alone on its own. It can stand alone on its own, but can also support. I mentioned we use this to support the implementation of our ESOP at MarshBerry. So debt capital raising can support internal perpetuation. It can support ESOPs. It can somewhat support an equity partner, although they're likely bringing the capital to the table. So it has the ability to support, other paths here. But it's certainly something that can be explored on its own. It may not seem like it's the best time to raise debt. However, debt is still cheap comparatively to other facilities and can be a good way to kind of fund growth either through acquisition or organically. The nuance is that our firm, MarshBerry, has the ability to work with lenders who understand your business and are willing to lend on cash flows as opposed to more traditional asset-based lenders. And that's a critically important distinction that can make or break a successful financing decision. So you've got to develop a capital strategy and what you're going to use the funds for, how you're going to get the cash flow to support it, develop a risk profile assessment. What are the risk concerns? What are the growth assumptions? How are we going to pay back debt? What are the other investment considerations? Knowing and having access to lenders and investors I just talked about on the previous slide. And then negotiation and closing advice is a often overlooked component of debt financing, talking about what are the appropriate interest rate options, maturity options, fixed or floating debt options, security interests, covenants, acquisition criteria, commitment and facility fees, financial reporting requirements. I mean, the list goes on certain things that you can negotiate in debt capital, financing. So important to have someone who knows that space well. It can also be used to refinance existing debt to lower your total cost of capital, perhaps remove personal guarantees, push out principal and interest and maturity payments. It can be used to augment an M&A strategy, including immediate access to financing for future deals. It allows you to be more competitive on pricing in situations you might need to move quickly. And it gives you more knowns on cost of debt, the covenants, things like that. Can also be used to address short-term capital shortfalls in the event you needed access to call it a revolver or a line of credit. That typically only needs repayment maybe once during the calendar year, maybe less often than that, but it can be used to address short-term capital infusion needs as well. And finally, it can provide partial liquidity. So this is more akin to like an internal perpetuation strategy. You can raise capital to pay a special dividend, buy back shares from equity holders, facilitate internal perpetuation transactions. Again, the list goes on in that stratosphere. Another outside the box option to consider is the formation of a regional national, broker. One you probably don't think of too often. It's not very common, but you might have a cluster or group of agencies that you're interacting with from a peer-to-peer standpoint that all bring different strengths and skill sets to the table. They share common goals and objectives that you might considering kind of banding together to row in the same direction as part of one big ship, versus rowing in the same or different directions independently. This is the classic adage of really strength in numbers. We've helped firms go multiple times from kind of being prey to predator through broker formation. A few examples of that: in end of 2016, 2017, we formed the Alera Group. 24 firms rolled up to create a $160 million broker, 750 employees, 40 offices across 15 states. We got a private equity sponsor in Genstar Capital. And in 2016, it was the industry's second largest deal in terms of valuation that was put together. So this stemmed largely from the peer-to-peer agencies of the Benefit Advisors Network, or BAN, for those who are familiar with that. But again, it was agencies that all brought different strengths, weaknesses, and profiles to the table. In 2019, beginning of 2019, we created Patriot Growth Insurance Services. This was 18 firms, similar to Alera, 18 firms, 7 states, private equity sponsor with Summit Partners, and it was our second national broker formation that we did behind Alera. This again stemmed from a peer-to-peer network of True or United Benefit Advisors, UBA, for those that are familiar with that, but showcased a different option for those that were looking to perpetuate. In 2020, we formed Oakbridge. This was a smaller scale, 4 organizations that came together to create about a $32 million broker, largely in Georgia, sponsored by Corsair Capital. And this was our MarshBerry's third foray into brokerage formation. Most recently, that closed earlier this year, we did Lacent, which again closed March of 2023. And this was our 4th broker formation in totality, and first in the European kind of broker market. So very excited about that. So it's an interesting option. The obvious advantages of you bring a bunch of different people together and construct the culture you want to create and maintain. You crystallize the valuation when valuations are high, and you trade at a multiple that you might not have been able to transact at had you done this on your own at a smaller scale. The magic is all on the tax and equity side. There's tax deferrals on rolled equity. You can roll equity into and leverage debt to gain access to greater equity ownership. And you can bring other partners in over the course of time and utilize some of that equity to increase valuation. But wait, there's more, right? There's a bonus option, and that's if you can also enjoy, or that's that sweet sound, I should say, of kicking the can down the road, that the future you can deal with the larger problem that the current you doesn't currently want to address today. So you can always do nothing and hope it gets figured out. Unsurprisingly, our viewpoint is that not really a viable option for a lot of different reasons. Mainly that the ownership continues to age, the culture deteriorates, you don't perform the level of investment you typically, would want to perpetuate, and inevitably you'll end up selling at a discount, or walking out the door, right? One of those two things for options. So do nothing is an option, not an option we obviously recommend. So in kind of summation, it starts with learning more about your options, talking with myself, Jen, or really anyone at MarshBerry through the perpetuation and strategic planning process and phases. The more informed you can be about the decisions you make around the options is certainly in your best interest and the future of your agency, whether it's internal, external, ESOP, capital, raising debt, forming a broker. Notice how I didn't mention kicking the can down the road. There's a lot of other options out there that you should seriously consider and explore to understand what makes the most sense. So I urge you, please, please, please do something, right? And plan for your own succession. There's no downside to planning for it, but there's a huge risk in ignoring it. If you don't have a plan, reach out to us to start a conversation. If you have a plan, reach out to us to continue the conversation to make sure you understand some of the other options we talked through. And if nothing else, confirm you're on the right path. We would certainly be honored to have that conversation with you and assist you in, again, what's probably one of the most important matters with one of the most important assets you have at your disposal. And I assure you, it's not something we take lightly because we've done, multiple of these paths on our own. So that concludes, our content for today. And at this time, I'm going to turn it back over to Jen. I don't know if we have any questions or closing comments in the chat, but Jen, I'll turn it over to you.
Thanks, Kyle. Yes, we've had some questions come in. And first, just want to take care of some questions around some housekeeping items. There's been questions on if the slides will be available. We will be sending out a follow-up email with some key takeaways The whole deck itself will not be available, but we also, have recorded the webinar, and the recording can be made available if necessary. A couple other questions, that we've received. One being, do you ever have clients start going down a path that then later decide to pivot to another? How difficult is it to change course once you kind of set down a path?
Sure. Yeah, that's actually a very thoughtful question. And the simple answer is yes. Sometimes pivoting is required. That's the beauty of this process and exploring this process, is that it allows you to explore several options at once, or at least have a contingency plan in the event the preferred option for some reason is no longer feasible. For example, we often have clients that truly want to explore internal perpetuation, but also admit they don't know what the cash flows look like. They don't know if they have the next generation. They're still evaluating some of that, and it may not be feasible once you actually get into it, given the situation. And so then we could consider exploring debt capital raising to fund the internal perpetuation, or perhaps they would pivot to a external sell side through a strategic buyer if internal becomes unrealistic and they're unwilling to take on debt to kind of fund some of the internal options. So, the bottom line is you should explore most all of these options. Certainly not every option is going to be applicable, but it's very common to have more than one option that may work. And there's really not a ton of heartburn in terms of pivoting. It's more just understanding what's your preference, and then understanding if that can truly be a realistic option for you, is the most important component. And we won't know that until you kind of get into some of the conversations and some of the data.
Okay. And another question that we received is perpetuation planning a standalone service, or is it part of a more global, engagement with MarshBerry? Like what does a perpetuation engagement look like?
Sure. Perpetuation planning in and of itself should be considered a standalone offering that deserves the time and attention kind of necessary to craft a quality plan. With that said, perpetuation planning, I would also make a strong argument, should be a major component of the organization's overall strategic planning, because the day-to-day blocking and tackling of the organization, its goals, the rocks it's trying to push uphill, should complement the perpetuation plan, and in some cases enhance it. The worst thing you can have is a strategic plan that is in direct conflict, in part or in whole, with your achievable perpetuation plan. And that's why we're huge proponents of strategic planning overall on an annual or semi-annual basis, because that's really a foundation that supports all other initiatives. So we do strategic planning, and that would incorporate the perpetuation plan, which is also kind of its standalone living, breathing organism that needs to be executed. But you certainly want all of those to row in the same direction. So happy to chat through specifically. Again, reach out to Jen or myself if you're looking for a scope on what perpetuation looks like for you as an organization. Those are customizable plans, and we certainly want to make sure it's incorporated into any greater strategic plan you might have out there.
All right. Thanks, Kyle. We are at time. If additional questions, come up as you're thinking about, what Kyle shared, please don't hesitate to reach out to us. We will be sending out that email with key takeaways, and we'll be in touch.